Hi, welcome to the Deep Dive. Today, we're pulling back the curtain on Volati AB.
That's VO on the ticker, the Swedish Industrial and Acquisition Group.
Exactly. We're dissecting their Q2 fiscal 25 results. They landed pre-market July 14th. And, well, they threw a bit of a curveball, didn't they?
They certainly did, especially if you were looking at that strong Q1 they had. This Q2 maybe landed with a bit more of a thud.
Yeah. So our mission today, let's unpack these numbers. Let's try and understand management's view. They're calling it a hiccup.
A hiccup, right? We'll see about that.
And figure out what it all means for investors looking at Volati.
Okay, so let's start with the headlines because they told the story pretty quickly.
Hit us with them.
Net sales. SEK 2.317 billion. The street was looking for SEK 2.43 billion. So a noticeable miss there.
Okay, top line miss. What about earnings?
Same story. Diluted EPS came in at SEK 1.47. Consensus? More like SEK 1.81.
Oof. So a material miss on both. Not much ambiguity there.
Not really, no. And you also had EBITDA basically flat compared to last year, SEK 245 million.
And organic sales.
That actually slipped by 1%.
Right. So that combo definitely wasn't what the market wanted to see. But you mentioned bright spots earlier. It wasn't all bad.
No, exactly. You have to look at the segments. Salix and Etiquetto, both business areas, posted double-digit growth on the top line.
Okay, so strong performance there.
Yeah, really strong. And that did help, partly offset weakness elsewhere. The industry segment particularly was softer.
We'll dig into that. But first, the market reaction. How did investors take this mixed bag?
Well, the stock felt it, no question. Volati closed down 2.7% on July 15th at SEK 110.00.
And the volume.
Triple the average, which, signals pretty strong conviction. It even dipped lower during the day, hit SEK 107.40 at one point.
So people were maybe bracing for some slowdown after Q1. But this miss, plus keeping guidance flat.
Exactly. It seemed to rekindle those worries about acquisition dilution. Are the new buys pulling their weight immediately?
Right. And then you layer on the macro headwinds.
Yeah. And what's interesting, some of their Nordic peers, other industrial holding companies, they also dipped intraday, but mostly recovered by the close.
So Volati's drop was more company-specific, not just the whole sector getting hit.
Largely, yes. It really underscores that. And remember, the stock was already down about 14% coming into these results.
Why was that?
Mostly those softening PMI numbers, the manufacturing indicators, plus a general rotation out of Swedish small caps.
Okay, so the Q2 miss just kind of poured fuel on an existing fire, accelerated that derating.
Pretty much, yeah. The market was already getting cautious, and this confirmed those fears for many.
Got it. Okay, so management calls it a cyclical hiccup. CEO Andreas Stennebeck sounded confident, reaffirmed the M&A model.
Right. He emphasized the strong cash flow expected in the second half, the balance sheet strength, net debt to EBITDA at 3.0, right in their target range.
Leaving room for more deals, he argued.
That's the line, yeah. That they have the headroom to keep acquiring when markets get better, or even now.
But the question for investors is it just a hiccup? Or is there something more going on with the strategy's resilience in this environment?
Well, they did point to structural measures they've put in place over the last couple of years.
Things like cost controls, integration efforts.
Exactly. And they say they're seeing benefits, especially in Salix and communication. Margins holding up better there, even with weak organic growth.
So some underlying resilience being built.
That's the argument. They did flag about SEK 6-7 million in extra costs in Q2 for more structural work, with more coming in Q3.
But they framed those as sort of ongoing operational tweaks, not panic measures.
Right. More like fine-tuning the machine.
Okay, let's dig into those segments you mentioned. Salix Group, what happened there?
Good story there. Sales up about 10% overall, mostly acquisitions driving that, but some organic contribution too.
And profitability?
EBIT up 20% year on year. Margins improved by about 1 percentage point. So that points to those cost controls and synergies working.
Mm-hmm. And they did another add-on acquisition there too, right?
Yeah, Hans Eggerstrand in Q2 fits into their consumables and agriculture unit. They see synergy potential, especially logistics.
Okay, Salix looking solid. What about Etiquetto?
Continued strong. Sales jumped 36%. Big boost from the Clever acquisition, but still good organic growth too.
Nice. And EBIT?
Up 19% in nominal terms, mostly organic improvement driving that. But the margin did dip, down 2 percentage points.
Why was that?
Mainly Clever. It's a big part of the group now, but came in at a lower margin profile.
So integration drag on the overall margin.
Temporarily, yeah. They say integration is going well and the plan is to lift Clever's margins up to the group average over time.
Right. That's always the key with acquisitions, isn't it? How fast can you actually realize those synergies and margin improvements?
Absolutely. It's one thing to buy growth, another to make it profitable growth quickly.
Okay, so Salix and Etiquetto, positive stories overall. Then there's the industry segment. Sounds like that was the main weak spot.
Definitely the tough one this quarter. Revenue down 7%, EBIT margin dropped 1 percentage point.
What drove that?
Mainly two parts, Tulum Group and Corventa. Tulum is facing, well, management called it a historically weak market.
A perfect storm even, I think they said.
Yeah. Things like subsidies not materializing, lower grain prices, uncertainty around tolls, interest rates, just a confluence of factors hitting them.
Wow. So that really shows how even a diversified group isn't immune to deep cyclical issues in specific niches.
Exactly. It's a good reminder. They said the market can turn quickly when confidence returns, but they haven't seen that turn yet.
And Corvento.
Less about market weakness, more about tough comparisons. Last year's Q2 was very strong for them. They didn't see big impacts from recent floodings, apparently.
Okay. And elsewhere in industry. Sanct facing weak construction demand, but infrastructure holding up.
That's right. And communication actually did well, improved EBITDA despite lower U.S. deliveries. So again, a bit mixed even within the segment.
Let's step back a bit. You mentioned the balance sheet, the 3.0x net debt to EBITDA. How much has that relatively healthy capital structure helped them keep buying?
It's been crucial, really. They've added over SEK 750 million in annual sales through acquisitions in the last 12 months alone.
While staying within their debt target.
Right. And management sounds very confident about cash flow, especially in the second half, which is typically stronger for them.
Giving them firepower for more M&A or to pay down debt if needed.
That's the idea. They believe the combination of decent margins, those structural fixes, and eventual organic growth recovery will let them manage debt while still doing deals.
And the cash conversion numbers look okay.
Yeah, operational cash flow is up 27% in Q2. Cash conversion over the last year is 85%, which they see as in line with their goals. Solid.
It's interesting. Despite the Q2 organic dip, the CEO stressed that the market now is still way better than early 2024, when organic declines were much steeper.
True. They see an underlying positive trend still. And if you look at the first half of 2025 overall,
sales up 10%, some organic growth for the half, EBITDA up 13%.
Which is actually pretty close to their financial target for EBITDA growth.
It's almost like the market has this split personality with these companies, you know? Loves the growth story, then gets spooked by any wobble. It's a real dance.
It is. And management acknowledges the sort of growth gap that opened up after 2021 when the pace slowed.
But they're betting they can close that gap.
They seem confident. They talk about accelerated organic growth kicking in when the market fully returns, leading to a real nice journey. We'll have to see.
All right. We've heard the numbers, the context, the management view. Time for our disclaimer-heavy segment.
Yes. This is not financial advice segment, just some outrageous but plausible ideas.
Yeah.
Emphasis on not advice.
Definitely not advice. Okay, idea number one.
Okay, so maybe a short-term contrarian play. The stock got hit hard, down 14% before earnings, then dropped again on company-specific news.
Right.
Management is sticking to their guns on structural improvements, second half cash flow for M&A. If you think the market may be overreacted to a cyclical hiccup,
then maybe there's a bounce back.
Could be. An opportunistic short-term long position if you can stomach the volatility.
Betting the market overcorrected.
Okay, that's one angle. What about a longer-term view?
For the patient investor, if you buy into the long-term M&A compounding story
and believe this growth gap is temporary,
then maybe accumulating shares on this weakness makes sense. Management keeps stressing their build to acquire through cycles.
So a bet on that real nice journey they mentioned, powered by acquisitions once the market recovers, accepting near-term pain for potential long-term gain.
Essentially, yes. A bet on their model compounding over time.
Okay, but just to hammer it home one more time.
These are speculative ideas,
Yeah.
not financial advice. Please do your own homework.
Absolutely crucial. Okay, so wrapping up. Management seems confident this growth gap will close. The fun journey starts when the market turns. It leaves us thinking.
What needs to happen for that?
Exactly. What key macroeconomic signs or maybe specific regional shifts do you think need to fall into place for Volati's accelerated organic growth to really kick in? Something for you to chew on.
Definitely. We encourage you to take this info and explore further on your own.
Thanks for tuning in to the Deep Dive.